shall now discuss about valuation of goodwill on retirement or death of a partner. So what happens in the case of retirement or death? The portion of the goodwill of the firm belonging to the retiring partner or to the deceased partner has to be paid by the firm to the continuing partners or surviving partners to the retiring partner or the heirs of the deceased partner. So if there is a retirement of a partner, the partners who continue in the business will have to pay the money to the retiring partner. If there is death of a partner, then the surviving partners, that the remaining partners, will have to pay money to the legal heirs of the deceased partner, that is the partner who has died. This is because the existing partners gain in terms of increase in the share of profits, because one partner is going away either on account of retirement or death. So they will have to bear that money which is to be paid to the retiring partner or the legal heirs of the deceased partner in the same ratio in which they are gaining. Suppose one gains more, he is required to pay more, one gains less, he is required to pay less. So for this purpose we are required to calculate the gaining ratio of the existing partners. Based on that we have to pass the entries for the goodwill. So these are following entries need to be passed in the case of retirement and or death of a partner. So when the goodwill is raised at full value in the books of the firm and the goodwill account is retained, that means in the situation where goodwill is calculated for the entire firm, not only the share of the retiring partner, but for the entire firm, and that value of the goodwill is retained in the books, that means it will continue to appear in the balance sheet of the entity. In that case, first we have to raise the goodwill in the books of the firm by debiting goodwill account and crediting old partners capital accounts in the old profit sharing ratio. Suppose there are 3 partners and all the 3 partners will get their share of the goodwill. So therefore that amount will be credited to their respective capital accounts. And this is how it is done. That means the retiring partner's share will automatically go to the retiring partner's capital account, which he will withdraw, or in the case of death it will go to the capital account of the deceased partners, which will be eventually paid to the legal heirs of the deceased partner. This happens when the goodwill is raised for the entire value and then also retained in the books of the firm. And in many cases goodwill is not normally retained in the books of the entity. They raise the goodwill and then immediately it is written off. So in such a case, when goodwill is raised at full value and then immediately written off in the books of the entity, then we have to pass the following entries. One is goodwill account first has to be raised in the books. So you debit goodwill account and credit all the old partners account in the old profit sharing ratio. That means including the retiring partner and or the deceased partner. And thereafter goodwill account is written off from the books. That means goodwill account is credited and the continuing partners capital accounts are debited in the new profit sharing ratio. So the first one, all the partners will get their share of the goodwill by crediting the goodwill in the old profit sharing ratio, and it is written off from the books of the entity by crediting goodwill account and debiting the continuing partners capital accounts. That means only those partners who are continuing in business after the retirement and or death of a partner, and this will be done on the basis of the new profit sharing ratio. So or alternatively, instead of doing this, goodwill need not be written off at all. Directly we can debit the retiring partner or the deceased partner's account and credit the continuing partner's accounts, or alternatively debit the continuing partner's capital account and credit the share of the goodwill of the retiring or deceased partner. So that also can be done without raising goodwill at all. So therefore what we do is, when only goodwill is raised in the books of the entity to the extent of the share of the retiring or deceased partner, then goodwill account is debited to that extent only and credit is given to the retiring or retired or deceased partner's account, capital account, it is credited. And thereafter goodwill is written off in the books of the entity by crediting goodwill account and this is done by debiting the existing partners, that is continuing partners capital account. So what we do is continuing partners capital account is debited and goodwill account is credited. So goodwill account is written off from the books of the entity. And so we have considered two situations. One is what happens when there is admission of a partner. Second is what happens when there is retirement and or death of a partner. The third situation is when there is no change in the partnership deed except to the extent of the profit sharing ratio. There is only change in the profit sharing ratio. The number of partners remain the same. The partners remain the same. There is only inter se adjustment of the profit sharing ratio. In this case also we are required to calculate the value of the goodwill, because some partners will be gaining the profit sharing ratio, some partners will be losing. That means they are sacrificing their profit sharing ratio. So those who are sacrificing or losing will have to be compensated by those who are gaining the ratio. So this can be done directly by crediting the partners capital accounts of those partners who are sacrificing the profit sharing ratio and debiting to the partners capital accounts of those partners who are gaining. That means those people are paying to the partners who are sacrificing. That is one way of passing the entries. So the entries will be debit partners capital accounts of those partners who are gaining the profit sharing ratio and credit to the partners capital accounts of those partners who are sacrificing their profit sharing ratio. Alternatively, we can also raise the value of the goodwill in the books of the entity by crediting the partners capital accounts in the old profit sharing ratio. So the entry to be passed is debit goodwill account and credit all the partners capital accounts in the old profit sharing ratio. That means whatever share they were enjoying earlier before the change took place, it will be credited in that ratio. So let us understand this with the help of a problem. Let us say A and B are partners sharing profits and losses in the ratio of 5:3. That means A share is 5 out of 8 and B share is 3 out of 8. And there is an admission of a partner called C. He brings 70,000 rupees in cash and 48,000 against goodwill. New profit sharing ratio between A, B and C is decided at 7:5:4. So we have to pass the necessary entries in the books of the entity. For this purpose, first of all we have to find out as to what is the old ratio and what is the new ratio and to what extent each partner has lost or gained. That is done by calculating both the old ratio and the new ratio and taking the difference between the two. So as you see on the board, A old ratio was 5 and B's was 3 and C was nil in the old ratio. In terms of new ratio, A has got 7, B has got 5 and C has got 4. So the gain of C will be at the expense of A and B, that is the existing partner. So A's loss will be 5/8, which was his old ratio, minus 7/46, 7/16. Therefore, his sacrifice will be to the extent of 3/16, whereas B's sacrifice will be 3/8, that is the old ratio, minus 5/16, that is the new ratio. So his loss will be 1/16, whereas C's gain will be 4/16. So the loss of A and B is equal to the gain of C. So that is how the sacrifice ratio and the gaining ratio is calculated. Now we have to pass entries. What is he bringing in terms of goodwill? He is bringing 48,000 rupees in terms of goodwill. So cash or bank account is debited with 48,000. This is the money brought in by C, and goodwill account is credited with 48,000. And goodwill account has to be written off. So goodwill account is again debited and A and B's capital accounts are credited in the old profit sharing ratio, because this money actually belongs to A and B. They were the earlier partners. So they have to share the goodwill in the old profit sharing ratio, that is 5:3. So A will get 36,000, B will get 12,000 rupees. So goodwill account debit and A's capital account 36,000 credit, B's capital account 12,000 credit. So what happens? Goodwill has been written off from the books of the entity. Now only it will appear in the form of A's and B's capital accounts and cash or bank account. Or we can also pass entries in terms of the goodwill for the entire firm. C's share of goodwill is 48,000. So what is the total value of the goodwill of the firm? That will be 4 times the value of 48,000, because C's share is 4 by 16, that is 1/4. Therefore, total value will be 4 times 48,000, that is 1,92,000. So you raise goodwill in the books of the entity to the whole extent, that is debit goodwill to the extent of 1,92,000, and A's and B's capital accounts are credited with the old profit sharing ratio. That means A gets 1,20,000, B gets 72,000. Now goodwill has to be removed from the books of the entity. Therefore, goodwill account has to be credited with 1,92,000. This has to be shared by all the 3 partners, including the partner who has been admitted in the new profit sharing ratio. So A's capital account will be debited with 84,000, B's capital account will be debited with 60,000, and C's capital account will be debited with 48,000. So what is the effect of these 2 entries? In effect, A is gaining 1,20,000 and losing 84,000. So his net gain is 36,000, which is the same as the earlier entry. Similarly, B is gaining 72,000 and losing 60,000. So his net gain is 12,000. Whereas C is gaining 72,000 and also losing 72,000. So there is no effect in the capital account of C. So ultimately, what we have done is we have credited the capital account of A and B only to the extent of 36,000 and 12,000, and cash and bank account has been debited with 48,000. This is the same thing. So these kind of entries will serve different purposes. The idea of raising the entire goodwill in the books of the entity is to have record of the total value of the goodwill of the firm. Therefore, some entities may raise the entire goodwill in the books and then they write it off. So now let us take another problem in respect of the change in the profit sharing ratio. So here A, B and C are the partners sharing in profits and losses in the ratio of 3:2:1. That means C gets 3 by 6, B gets 2 by 6 and C gets 1 by 6. They decide to change the profit sharing ratio to 2:2:1. That means A will henceforth get 2 by 5, B also will get 2 by 5 and C will get 1 by 5. Goodwill of the firm is valued at 30,000 rupees. We have to pass the necessary journal entries if goodwill is not appearing in the old balance sheet and will also not appear in the new balance sheet. That means goodwill will not be appearing at all. In such cases, how to pass entries? So first of all, goodwill is valued at 90,000. So you debit goodwill of 90,000 and ABC capital account is credited with 30,000, 30,000, 30,000 each. And in order to reverse that goodwill account, A's and B's capital accounts are debited with 45,000 and goodwill account is credited with 90,000. So ultimately what it means is C's capital account is credited with 30,000 and A and B's capital account is debited with 15,000 each. So what it means? Here somebody is losing and somebody is gaining. For that you have to find out that first before passing the entries. So what is the gain of somebody? In the case of C, C is now getting 1 by 5, whereas earlier he was getting 1 by 6. So there is a gain in the profit sharing ratio of C, which is lost by the other 2 partners A and B. Therefore, the goodwill has to be shared by A and B and given to C. Therefore, A and B's capital accounts are debited with 15,000 each and C's capital account is credited with 30,000. Now we will talk of admission of a new partner into the entity. What happens? Whatever, apart from valuation of goodwill, we are required to pass lot of other entries in terms of admission of a partner. So far we were concentrating our energies on only trying to find out as to how to compute the value of the goodwill and how to pass entries in respect of goodwill. But whenever there is a entry of a new partner, we need to do a lot of other things other than computing the value of the goodwill. So, what is to be done in this case? First of all, we have to have a revaluation account, or what also known as a profit and loss adjustment account, and the reserves in the balance sheet also have to be passed on to the old partners, because they actually belong to the old partners, and we have to compute the new profit sharing ratio, and finally proportionate capital and inference of goodwill has to be made and entries have to be passed. So, let us now understand all these things one by one. So, what happens when the new partners are admitted? So, new partner is admitted to the benefits of the partnership. That means, he will be getting profits in future in the profits of the firm. So, either he is required to, he is taken either to bring in more capital or to strengthen the management of the company. That is the normal reason for inducting new partners into the firm. So, when the new partner is admitted into the firm, the balance sheet has to be updated. So, how do you update the balance sheet? What you have to do is, you have to revalue all the assets and reassess all the liabilities. That means, the value of the assets have to be revalued. You have to find out what is the value as on date, and similarly, if there are any changes in the liabilities, they have to be accounted for. And in addition to that, we have to value the goodwill, and after this we have to recast the balance sheet to reflect the revised capital accounts of the continuing partners. The result of revaluation, reassessment of liabilities and computation of goodwill means that there will be changes in the partners' capital accounts, that is those partners who are the existing partners. So, the money they are entitled to get from the partnership firm. So, let us now understand what is the meaning of revaluation account, or also known as the profit and loss adjustment account. So, when a new partner is admitted, assets are revalued and liabilities are reassessed. A revaluation account is opened for the purpose. So, what happens whenever there is a reduction in the value of the assets, this revaluation account is debited. That means, there is loss of value, and whenever there is increase in the value of assets, this revaluation account is credited, and exactly the opposite happens. Whenever there is an increase in liabilities, revaluation account is debited. Whenever decrease in the value of liabilities, revaluation account is credited. So, to put it shortly, the account is debited with all reduction in the value of assets and all increases in liabilities, and the account is credited whenever there is increase in the value of assets and decrease in the value of liabilities. And the difference after doing all these adjustments will be either profit or loss. It could either show higher credit balance or higher debit balance. If it is a higher credit balance, that means there is a profit. That means the partner's capital accounts will get adjusted to that extra account. So, this amount is transferred to the capital account of the old partners in the old profit sharing ratio, because this money actually belongs to the old partners. So, the entries to be passed are: first, revaluation account debit. So, when you debit the revaluation account, whenever there are increases in the value of liabilities. So, to the liabilities account individually with the increase in the liabilities, and also to assets account individually with the decrease in the asset value. For example, if there is increase in the value of land, then the revaluation account has to be credited and the respective asset account has to be debited. Similarly, when there is a decrease in the liability side, the respective liability account has to be debited and the revaluation account has to be credited. So, we have to pass different entries individually for each item of liabilities and individually for each item of assets, and only in those cases where there is a change in the value as reflected in the balance sheet. If there is no change in the value of the asset or liability after reassessment, then there is no need to pass any entry. Only in respect of those assets and liabilities where there is a change, we need to pass the entries. And once this is done, if there is a credit balance in the revaluation account, then the revaluation account is closed by debiting the revaluation account and crediting the amount to the capital account of the partners, that is old partners. Or if there is a debit balance in the revaluation account, then revaluation account has to be credited to close that account, and the partner's capital accounts will be debited